Hey, welcome back to The Dive. Interest rates, housing prices, oil, and sectors he's interested in for Q1 of this year are the topics that our guest will deep dive into today. He is the Chief Investment Officer of Oxbow Advisors. Chance Finucane's joining us today. But before we bring Chance on, just a friendly reminder to smash that subscribe button for me, please. Hey Chance, welcome to The Dive.
Hi Cassandra, thanks a lot for having me.
Yeah, thank you so much for joining us today. All right, so let's begin with this. So stocks have risen at an average annualized rate of 9% during the 12 Fed rate hike cycles since the 1950s and delivered positive returns on 11 of those instances. Do you think this indicates that 2022 is likely to end on a better foot than it started?
It's possible. I think what makes this rate hike cycle different from the past is that there usually was a bigger spread between short-term treasury rates and long-term treasury rates so that the Fed could raise the Fed funds rate and not invert the yield curve, where say the 2-year treasury rate would be higher than the 10-year treasury rate, which tends to precede recessions in the economy. This time around, you've really only got less than 1% difference between the 2-year and the 10-year treasury rate. And as they start hiking into that, it might make for a more choppy environment for the stock market rather than what you had in previous hiking cycles where there was a lot more room to go.
Okay, well, we'll just have to see what happens then, I guess. Yeah. So let's move on here. There's a lot of talk all over social media of housing being out of control, with record low inventory and lots of demand. Do you think this could end like 2008?
I don't know that it's going to end that badly, because if you think back to that stretch in the mid-2000s, there were homes being given to people who had no way of being able to afford the houses they were purchasing. Whereas today, you're seeing more lending going to credit-worthy borrowers that are trying to buy those houses. But there is going to be a point where you see housing prices hit a level that there's going to be a slowdown in home sales around the country, where you see a lot of millennials trying to buy their first homes. They're just not going to want to pay up for these prices. And so you might see somewhat of a correction in the housing market to get back to levels that you end up seeing a little bit more balance rather than just home prices going up as much as they have these past couple of years.
Yeah, it's crazy. Okay, so let's shift to oil now. There are growing concerns about the Russia-Ukraine conflict. Do you believe this could affect gas prices in the U.S.? Is there a cap or a ceiling at which you think these oil prices can top off?
Whenever you have geopolitical tensions, that could always carry over into the oil or natural gas market. I think for the U.S. natural gas market, it's more the natural gas being produced here domestically rather than what the price of natural gas is overseas. But there is some idea where if you have an increase in demand where that ends up being higher than the amount of supply that's able to come online in a short period of time. If you think over the last 5 years, there's not been a lot of additional exploration and production of new oil wells. And so it's going to be a little bit of a lag for them to catch up if there is an increase in oil demand globally. So we're a little bit trying to stay balanced on both sides. We think there could be a bit of a slowdown in economic growth, but at the same time, in the long term, if you do see demand for oil and natural gas increase, we don't know that supply is going to be there, and that could lead to higher prices even than what you see today.
Definitely. All right, so let's talk about Oxbow's most recent market commentary titled Fantasy Meets Wall Street. Can you give us some color on this? And where do you think the meme stock craze is going?
So what we've noticed in the last couple of years is that with all of the monetary and fiscal stimulus that was flushed into the marketplace, we saw a lot of assets, whether it's cryptocurrencies or companies that generate no profits, skyrocket to levels that you've never seen previously. And now that you're starting to see some of that monetary tightening and some of that liquidity go away from the system, and the money supply growth around the world is starting to decelerate and go back to more of a flat level compared to last year, that's going to pull away where some of that extra money was going to these sorts of meme stocks. And I think that's where you're seeing the biggest declines in the market today. And you're really going to want to focus more of your investments on companies that are generating actual profits and consistent growth in free cash flow.
So what kind of sectors or industries are you looking at for Q1 of 2022? How are you positioning yourself? And where do you view headwinds coming from on the horizon?
For sectors for us, I think in our growth portfolio, we've seen a significant pullback in the tech and communication services sectors. So there are some companies there that we do think at current prices could double over the next 5 years. So that's some companies like PayPal, Charter Communications, or Adobe. And then on the income side, we still have some positions in the energy sector, just because we do think that that's generating a lot of good cash flow, for instance, in pipeline businesses. And there also are some real estate companies or REITs that are generating 5% yields that we think still provide pretty decent value for anyone that's trying to have that consistent dividend payment come through into their accounts.
All right. Well, thank you so much for joining us on the show today. It was so nice to meet you.
Thanks a lot.
Thanks so much for watching today. We'll be back again tomorrow. But in the meantime, don't forget to like, subscribe, and share, please.